Good afternoon, guys. This is again your Prof. Sus, and I'd like to welcome you to our session about auditing and assurance principles. Okay, let us first define what auditing is. So, auditing is a systematic process. Now, what do we mean by systematic process? When you say systematic and process, so two words there. It's a systematic process, meaning audit has a process that each and every accounting firm actually follows and observe. Okay, you don't just go to a client, a referral from even from your friends, from your family members. Okay, you just don't accept them. We need to have to follow certain steps. Say, for example, during the pre-engagement stage, you have to first evaluate your client if it's okay with you to be associated with them or not. Now, once they have accepted your proposal, then the planning phase would come in. Okay, so there is a certain process that we need to follow in order for us to be able to achieve the objectives of the audit. Okay, of objectively obtaining and evaluating evidence regarding assertions. Okay, objectively obtaining and evaluating evidence. What do we mean by that? In audit, we are actually obtaining evidences that would support the assertions of management as to the completeness, the rights and the obligation, the existence, the valuation, and of course the presentation and disclosure of the items in the financial statement. So we are audit is not just about proving; it's also proving and disproving the assertions made by management. And how do we do this? By obtaining evidences that would support whether the company is complying or not complying with the financial reporting framework that is applicable to them. Okay, so about economic actions and events. So these are actually transactions of the entity. So we are trying to verify about the existence of certain transaction and if these transactions are properly recorded and treated in the books of accounts. Why do we do that? Because we would like to ascertain the degree of correspondence, meaning are they in compliance with the financial reporting framework? That is what is being referred to there as established criteria. Now, in auditing, we use auditing procedures in order to verify whether the company is in compliance with financial reporting framework applicable to them. Now, how many financial reporting frameworks do we have? Now, if you still don't know, I'd like to refer you to SR 068 as amended. Get the most recent one, okay? Because 2019, there's another financial reporting framework that was introduced and now being implemented, in the Philippines, okay? And communicating the results to interested users. Okay, so the auditor communicates through the auditor support, okay? And the auditor support is attached to the financial statements of the entity, which are then provided to different interested users. So interested users meaning users within the organization such as management, and of course users outside the organization such as the BIR, the bankers, creditor banks, and then of course the suppliers and customers of the entity. So that's what auditing is. We are communicating the results of our audit because we are expressing an opinion. Okay? Now, what are the different types of audit? First and foremost, we have the financial statement audit. So this is an audit conducted to determine whether financial statements of an entity are fairly presented and in accordance with an identified financial reporting framework. Now, this is what what we're referring to here is the external audit, which is actually being done for compliance or statutory purposes. So entities in the Philippines are required to be audited by independent external auditors in order to determine whether the financial statements of the entity are fairly presented, okay, for use by decision makers and other stakeholders of the company. Second type is compliance audit. So compliance audit involves a review of the organization's procedures in order to determine whether the organization has adhered to specific procedures, rules, and regulations. Now, what is an example of this? So we're trying to prove whether the company is in compliance or not. Now, an example of this is the one that's being done by our friends from the BIR when they check on the tax compliance of the taxpayers. They look at the documents, then they check whether the company is in compliance with the rules of BIR when it comes to when it comes to recognizing expenses. Now, what are those rules? Say, for example, it has to be fully supported or duly supported with appropriate documents like invoices, official receipts. Okay, so no document to support the transaction. BIR would say that is not a valid transaction. Okay, so that is an example of compliance audit. Now, operational audit is a study of a specific unit of an organization for the purpose of measuring its performance and identify areas prone for improvement. So, operational audit is usually conducted by the company's internal auditor because it involves portions of the entity. Say, for example, a production manager would like to know whether he's doing the job right. So, the manufacturing operations can be subjected to an operational audit in order to check whether they are utilizing the resources properly, the machines, the raw materials, and all the stuff. And what is the purpose of this? Of course, in order to identify what are the possible weaknesses or areas for improvement. Okay, so those are the three different types of audit. Now, these are the services that the CPAs in public practice can offer to clients. Why? Because why are we focusing on CPAs in public practice? Because auditing theory is actually more on or tackles about CPAs in public practice. Okay, so we have the audit of financial statements, the review of financial statements, and then agreed upon procedures, compilation of financial statements, preparation of tax returns, tax accounting, management accounting, and other advisory services. Now, if you would notice, I divided the services into two. There are those on the left and there are those on the right. Now, why did I do that? The services on the left are actually the assurance type engagements. Okay, so audit of financial statements and review of financial statements. And the services on the right, these are the non-assurance engagements. Okay, why do we say those are assurance and the others are non-assurance engagement? What do we mean by assurance engagement? So when we speak of an assurance engagement, these are performed by professional accountants are intended to enhance the credibility of information about a subject matter by evaluating whether the subject matter conforms in all material respect with suitable criteria, thereby improving the likelihood that the information will meet the needs of an interested or an intended user. Okay, so an audit or an assurance engagement is actually what? Intended to enhance the credibility, because auditors actually are lending the credibility, okay, to the financial statements of an entity. Now, we have to remember that it is the management's responsibility. Okay, management has a responsibility over the financial statements. They are the ones who prepare the financial statements of an entity. Now, since they are the ones who are responsible and who prepare the financial statements, they need someone to tell the other users of financial statements that it's okay, that the financial statements are reasonable and conforms with a certain financial reporting framework that is suitable to them. Okay, that is why we say that, you know, independence of the auditors is a must when it comes to an assurance engagement. Okay, because we need to realize that there are parties or intended users of the financial information that are outside the organization. They don't have access to the records of the company, and so therefore the external auditor would do the job for them. Okay, so it's very critical that they have an independent external auditor. Okay, enhance the credibility of information about the subject matter. The subject matter here would be the financial statements of the entity. Okay, by evaluating whether the subject matter conforms in all material respect with a suitable criteria. Now, what is being referred to in this slide, the suitable criteria, is again the financial reporting framework that is applicable to the entity. Okay, because remember, the financial statements being issued by the management is actually intended not just for them, but also for other interested users like outside parties or parties outside the company. Now, the level of assurance provided by professional accountants' conclusion conveys the degree of confidence that intended users may place in the credibility of the subject matter. Okay, so it's actually the level of assurance of the external auditor, okay, that gives comfort to the intended users on, you know, how they what degree or what level of comfort that they would also place on the financial statements. Now, these are the parties involved in an assurance engagement. So we have the practitioner, the responsible party, and the intended users. Now, the practitioner, this is actually the professional accountant who will perform procedures, gather evidences, okay, regarding the financial statements in order to prove or disprove the assertions of management. Now, responsible party is the one responsible for the subject matter of an assurance engagement, which is the financial statements of the entity. And who is this responsible party? Now, these are, of course, members of management who engages the practitioner to audit the financial statements. Intended users are the persons or class of persons for whom the professional accountant prepares the report for a specific purpose. Okay, so intended users, these are the users of financial information, be it within the organization or outside the organization. Remember that they are also they are using the financial statements released by the company in making certain decisions. Okay, so therefore it is it is a plus factor if they see an auditor's report attached to the financial statements, because it increases their confidence that the financial statements are prepared in all material respects in accordance with a specified financial reporting framework. Now, what are the elements of an assurance engagement? So we have number one, the three-party relationship, which I've already discussed earlier. The subject matter, which is the financial statements of the company being audited. A suitable criteria here, again, refers to the financial reporting framework that is applicable to the company. So it is a must that auditors will have to understand and know and remember, okay, what are the financial reporting framework and when to apply the specific financial reporting framework to their client. Okay, again, if you don't know what are the suitable criteria, meaning what are the financial reporting framework that's currently in effect in the Philippines, then I would like to share with you SRC Rule 68. Please get a hold of that and you will find out what are the financial reporting frameworks in the Philippines. Okay? Sufficient appropriate evidence. Now, what do we mean by sufficient appropriate evidence? Like what I mentioned during our in the definition of auditing, audit is about obtaining evidences. So when you speak of sufficient here, we are referring to the sufficiency of the audit evidences. Okay, how many do we need as a sample, as evidence for a certain balance, for example, of a customer's account? Now, this is dependent on, of course, the judgment of the auditor. Okay, so is it sufficient? As we say sufficient, it refers to the number of evidences that we will be able to gather during the fieldwork. Okay, appropriate. So when you speak of appropriate here, this refers to the quality of your evidence. Okay, as what you will learn later on when you speak of appropriateness or quality of audit evidences. Like say for instance, you're trying to confirm the balance of the receivables. Now there are ways on how you confirm that. You can either, one is send a letter of inquiry to the company's bankers and then ask them how much is the balance of the company's accounts in your bank. Okay. Now if they will reply, then you have an evidence coming from an outside party. Okay. Now another way of doing that is by obtaining the passbook or bank records that's in the possession of the company. Now, is that appropriate? That is also appropriate. But of course, the evidences we gather from outside the company would be more reliable than the evidences that we will be able to gather within the entity. Okay, and of course, an assurance report. It is a must that assurance reports is in writing. Okay, because the financial statements will be given to different intended users. So it's a must that they have a copy of the auditor's report. Okay? So these are the items that are included in the subject matter of an assurance engagement. So if you would notice, it includes financial performance or conditions such as historical, prospective, financial position, financial performance, and cash flows. Well, otherwise, these are what? These are the financial statements of an entity. Okay? So non-financial performance or conditions like performance of an entity, physical characteristics like capacity of a facility, systems and processes like an entity's internal control or IT system, and of course behavior or processes as corporate governance, compliance with regulation, and human resource policies. Okay, so when you speak of suitable criteria, so when I say criteria, these are standards or benchmarks used to evaluate or measure the subject matter of an assurance engagement. These are important because they establish and inform the intended user of the basis against which the subject matter has been evaluated and measured, informing the conclusion. Now, as I mentioned earlier, when you speak of suitable criteria, this represents the financial reporting framework that the company used in the preparation of their financial statement. So, part of the auditor's task is to check whether the company is using the appropriate financial reporting framework when they prepare the financial statements. Okay, I have seen quite a lot of financial statements that actually were prepared with a wrong financial reporting standards. Okay, so you have to be very careful in identifying which financial reporting standards is applicable to your client. That's the first thing. Okay. So these are the levels of assurance in an assurance engagement. Now, what I've mentioned earlier is that regarding the degree of confidence that the users can place on the financial statements. Why? Because we have two levels of assurance in an assurance engagement. Number one is reasonable assurance. Now, this applies to audits of financial statements. Okay, so if you would notice, we use reasonable assurance. We are not using absolute assurance. Okay, we cannot give that absolute assurance to any of our audit clients. Okay, why? Because there are certain limitations, of course, of the audit. Like whenever we test, account balances, whenever we look for documents to support account balances of an account in the financial statements, okay, we are not doing it 100%. Okay, we are using sampling methods in order to draw conclusions, and then the conclusions will be used in order to draw our overall conclusion about the audit, whether the financial statements are in conformity with the specific financial reporting framework applicable to the company. And number two is limited assurance. So limited assurance is actually applies to the review of financial statements. Why limited assurance? Because in a limited review or a review of financial statements, the auditor is not doing a full scope audit. Okay, the procedures that he is performing for a review engagement is confined to like analytical review procedures, and therefore he's not able to really get competent evidential matter that would support a conclusion. That's why it's called a limited assurance. Unlike an audit that you are able to gather more evidences that you are comfortable with in order to express an opinion. Now, in a limited assurance engagement, actually the opinion that the conclusion that we are expressing here is expressed in a negative way. Now, reasonable assurance, we express it in a positive way, but for limited, we express it in a negative way. Now, what is the objective of a reasonable assurance? So here, this is actually to reduce, the reduction in assurance engagement risk to an acceptably low level in the circumstances of the engagement as the basis for a positive form of expression of practitioner's conclusion. Okay, so as you can see, reasonable assurance is actually what? In order to reduce the risk, engagement risk. Now we will define what engagement risk is. Okay, we are trying to reduce the engagement risk, okay, in an assurance engagement to a level that is acceptable to the auditor. Okay, that's why we express the report in a positive form. Now this is what is being referred to in the previous slide. Okay, the audit risk. So what is an audit risk? When you speak of audit risk, this is the risk that the practitioner will issue an inappropriate conclusion or will have an appropriate conclusion about the subject matter. Okay, so is there always this is audit risk always present? Yes. Why do we have this audit risk? Because we are appreciating evidences that we are gathering from our clients. So if we're not able to give a very, or if you're not convinced on the documents or evidences that we have gathered during the audit, then it will certainly affect our conclusion about the engagement. Okay, and so therefore it also will affect whether we have issued an appropriate or inappropriate conclusion. So say for example, we have audited a certain company, and based on the evidences we have gathered, we have issued a regular report, meaning an unmodified report. But it turned out that there's a problem on certain accounts that we are not able to see because we're using sampling method and all the stuff, and we're not able to appreciate. And so therefore, we issued a clean report when it should have been a modified or a qualified opinion. That is audit risk. Now, what are the components of audit risk? So these are the three components of audit risk. Okay. Number one is inherent risk. Number two is control risk, and number three, the detection risk. Now, for the first one, the first two items are actually within the company. Like say, for instance, inherent risk. When you say inherent risk, okay, so this is the risk of the account, okay, to be misstated. So this actually is dependent on the nature of the account, because there are accounts that are by themselves, okay, very risky or very susceptible to misstatement. Okay, example, revenues from construction contracts, okay, recognized under the percentage of completion. Now, who prepares the report about the percentage of completion? Now, of course, it's not the accountant, it's not the auditor, but rather another employee of the company, who is the perhaps project engineer or the architect. Okay, so as auditor, and based on our rules, okay, on our standards, the report on the percentage of completion is the one that we will use in order to find out or determine the amount of revenue that should be recognized in the financial statements. Okay, but how sure are we as auditors that the percentage there is reasonable? Okay, I'm not saying that it's 100% correct, but rather a reasonable value. Okay, so that is one thing that sometimes auditors are really finding difficult to verify. Okay, so that is the inherent risk. It depends on the nature of the account. Okay, control risk here is referring to the internal controls of the company. So when we say control risk, this is the risk that the internal controls of the company will not be able to detect. Okay, to detect or to correct the occurrence of the misstatements. Okay, so here we are dealing with the weaknesses in the internal controls. Companies have their own system of internal controls, but the question is, are the controls operating as planned? Okay, are they operating in order to detect and of course prevent errors and fraud from happening? Okay, if they are, then that's okay. I mean, auditors can rely on the internal control system set by the company. And what is the effect of relying on the internal controls of the company? Of course, there will be lesser samples that you have to gather in order for you to be comfortable about the figures or the balances of the accounts, and of course the disclosures in the financial statements. And the last component of audit risk is the detection risk. Okay, so when we say detection risk, this actually refers to the procedures, okay, employed by the external auditor. So when we say detection risk, the procedures that will be performed or is being performed by the auditor will not be able to detect or correct the misstatements. Okay, so if that is the case, then we can say that the audit procedures, okay, formulated by the auditors are insufficient, okay, or inadequate, that it's not able to detect the occurrence of material misstatements. Okay, now what is the objective of a limited assurance? Okay, so the objective of limited assurance engagement is a reduction in assurance engagement risk to a level that is acceptable in the circumstances of an engagement, but where the risk is greater than for a reasonable assurance engagement as the basis of negative form of expression of a practitioner's conclusion. So in a limited assurance, okay, as opposed to a reasonable assurance where we express a positive conclusion, a negative assurance is expressed in a negative way. Now remember that in a review or limited assurance engagement, we are conducting limited procedures, okay, and with the limited procedures that we are conducting, we cannot say that the accounts are fairly stated, right? Because we did not perform a full-blown audit. So that we have no right to say that, you know, the accounts are not materially misstated, or that the accounts are in compliance or in compliance with the financial reporting framework. Okay, and so therefore we are expressing our conclusion for a limited assurance engagement in a negative way, like nothing came to our attention that would cause us to believe that the financial statements are not prepared in all material respects. Okay, so that's how we word our conclusion in a limited assurance engagement. Okay, now again, this is a review engagement is an example of a limited assurance engagement. Okay, so this is conducted to provide limited assurance that there are no material modifications that should be made to the financial statements for them to be in conformity with the financial reporting framework. Okay, so as you can see here, they provide or review engagement provides limited assurance. Okay, limited assurance that there's no material modifications or exceptions, meaning that the financial statements are not in conformity with the prescribed financial reporting framework. Okay, that is a review engagement. Okay, so that's why we express we express our conclusion in a negative way. Okay. Now, another service that is a non-assurance engagement is what we call a compilation engagement. So it is a type of engagement where a company engages an outside accountant to prepare and present the financial statements. Now, as you would note in the definition of a compilation engagement, when you are asked to or engaged to perform a compilation engagement, you are not actually using your skills as auditors, but rather you are using your skills as an accountant. Okay, so when you speak of compilation engagement, and this is under PSRS 4410, you are being engaged to perform bookkeeping or accounting services for a client. Okay, and of course the standards also is aware that there are a lot of small companies who can engage accountants in order to prepare financial report, but of course there are some who really doesn't have any accountant within the organization, and therefore the one whom they will engage to prepare the financial statements would likely be doing the recording and the sorting of documents themselves. Okay, and of course business owners, because they trust the profession so much, okay, they can actually ask for pieces of advice from the accountant from time to time. Okay, now let us now compare the three services that I have mentioned a while ago. Okay, so that's the audit, the limited assurance engagement like the review, and of course the no assurance engagements like a compilation engagement. So in terms of the level of assurance that auditors provide, for audit we are providing reasonable level of assurance. Now for review engagements or review of financial statements, which is we are providing a limited assurance for those engagements. Okay, now for compilation, there's no assurance that we provide to the client. Why? Because we have not performed any verification. Okay, remember that in a compilation engagement, the accountant or the service provider has not validated any of the balances. Okay, because what he will do is just to collate all the documents, all the information that will be given to him by the owner, and of course arrange them into a meaningful format like the financial statements. Okay, but he will not perform any verification procedure. Okay, now with regard to the testings testings done for the engagement, if it's an audit engagement, okay, gathering of evidence to support the conclusion, meaning we have to follow what are the acceptable procedures in order for us to be able to obtain the necessary evidences in order to make a conclusion about the financial statements. Okay, now in terms of review of financial statements, okay, since we are providing limited assurance, we are also performing a limited procedures. Okay, our procedures is confined to what? Financial statement analysis or analytical review procedures. Okay, meaning we are just trying to explain what are the causes of the increase or decreases of the account, regarding the relationships of the accounts, and if based on our analysis, no, is there a possibility that the company's financial statements are misstated or not? That's why, as I mentioned earlier, we express it in a negative way. Nothing came to our attention. Okay. Now, in a compilation engagement, we are not testing. We're not doing any tests at all, because again, what I mentioned earlier, we are just performing an accounting function. Okay. As such, we are using our accounting expertise, okay, in doing or undertaking this type of engagement. Okay. So that's it for now, guys, and I'd like to thank you for listening, and of course you'll get a copy, of course, of this presentation material, so just attach it to our LMS. Okay, again, thank you very much. Stay safe, guys, and see you again for the second part of this discussion, and we will be discussing accountancy law. Okay, thank you very much, guys, and have a nice day. Stay safe, guys. Bye.